Okay, so good morning. My name is Árpád. I'm the CEO of TriGranit. TriGranit is an integrated real estate platform specializing in retail and office developments, property management of our own assets, asset management, and obviously acquisitions of these asset classes across the region.
So my name is Vlaho Kojakovic. I'm senior banker with the property team of EBRD based in London. We work in 36 countries now, from North Africa all the way to Ukraine and Turkey. And we do invest in all the asset classes, but most of our work in property and tourism sector is senior debt. We put a great emphasis on sustainability, both on the asset level as well as on the human capital level. So we'll touch on that a little bit later.
Great. Lila.
I've got mine. So my name is Lila Pateraki. I'm the Director of Investments for Zeus Capital Management. Zeus Capital Management is a boutique investment management firm that specializes in the acquisition of office properties in Central and Southeast Europe, so mainly Czech Republic, Hungary, Romania, and Bulgaria.
At Futureal, we are developers. We are based in Hungary, Budapest, but active in Poland and Romania as well. We have a staff of over 300 people, and we are active in residential. That's one leg of Futureal, brand name Cordia, and commercial, which means offices and retail.
Great. Bence.
Okay, my name is Bence, Head of Investment Services for Colliers Budapest. I'm running the investment services business line at Colliers. We are involved in advisory business to investors, developers across Hungary, and we also integrated part of the CEE investment business, so we're doing some cross-border works as well.
Okay, great. Maybe just starting with you, Vlaho, in terms of we had an interesting view there from Mark about the macro view. Obviously, that's something that the EBRD is looking at the whole time in terms of the kind of 36 countries that you're active in. So how do you see Hungary from a sort of macro standpoint? And how does that fit in with the other countries that you're looking at?
Well, I was briefly talking to Mark for 1 minute, and we agreed, and what came out in his presentation, that Hungary is a core market, and Hungary is a Visegrad group of the countries equivalent, and we see that both from the investment point of view and from the liquidity point of view. The growth of 2.5% to 3% over the next few years that EBRD is predicting for Hungary is there with a stable government, with a government which is probably going to continue beyond 2018 elections. And as the market actually is still here to absorb this 150 basis points difference that it had in terms of yields before the crisis, which is not the case anymore in Poland and Czech Republic. So even looking at it, as you said, in the group of these countries which are around from Germany east, I think Hungary still has the biggest potential for growth if you're looking at it from the potential for the investment. On the development side, we also see, and we are here very keen to get involved on both equity as well as debt side to help that growth.
And is that a change? Are you re-looking at Hungary in a different light? I mean, that suggests that you've not been active but are now looking to be more active.
We are. And I was mentioning to Lila before, EBRD has refocused both on property and tourism over the last few years. In countries like Slovenia, where we thought, our mission was finished 5 years ago, but with the crisis sweeping through it, there was a lot of NPLs to be cleared up on the bank side, but there was also a lot of sustainability to be brought into long-term thinking in the real estate industry. So we think that we can play a role.
Okay, good. And Árpád, you've obviously had... You're celebrating 20 years. I know Colliers is celebrating 25 years and PropertyEU has just celebrated 10 years, but it's not a competition. I was just saying at the beginning how much of a change I've seen here in this market particularly. Over those 20 years, what are the big changes that you've seen? Let's look at the region as well as Hungary. Slightly big question, I know.
20 years ago, I was 24 years old, and which is shocking. And actually, I was working for Healy & Baker at that time, which is Cushman & Wakefield now, here in Budapest. And next week is going to be 18 years ago when I joined TriGranit the first time. So it's interesting what happened. What happened? I mean, in '97, total office stock, Class A office stock, let's say in Budapest, was around 500,000 square meters. Today it's what, 3.6, 3.8 million. Retail stock, modern retail stock was 120, 130,000. Now it's, depending how you calculate, between 800,000 to up to 1 million square meters. And actually, we owned one of the shopping centers. I mean, TriGranit developed one of the shopping centers out of the two in '96, which actually wasn't TriGranit, but one of the founders of TriGranit, and then eventually became a TriGranit center, Polus Center. Yields were at 11.5%. Prime yield was 11.5%. Now it's still not at the peak before the crisis, but that's shown it's what, 6.5% to 7%, depending on the industry. And we know that around 2008, at the peak, prime yield was sub 6 for offices and around 5% for retail. So I think the market has gone through a huge change in perspective of volume, stock quality, financing being available. I mean, at that time, you couldn't even obtain financing. I mean, today we're talking about LTVs of 70%, or even, at certain times it was LTVs of 80%. At that time, you were lucky if you could get together one or two banks actually funding up to, 30, 40, or maybe 50% of the LTV for the development, and you had to find equity from alternative sources. So I think, real estate today is an industry, a very sophisticated industry, and even in CEE is basically on the same level as in the rest of the world. In '97, we were just learning it, and actually, thank God we didn't make the mistakes, because we could learn from the West, and a lot of things had been incorporated immediately. So basically all the developments, what started at that time, were state of the art compared to the Western European and North American markets, because we did enhance and implemented the latest findings and results. So if you look back 20 years, I think it's shocking to see to what extent these markets have grown, how much older I got, and how the markets have changed. But I think it's very interesting. If you look at what happened within the first 10 years, between '97 to 2007, when actually it peaked, yields dropped to the lowest level, development volume became probably peaked, investment volumes as well. And then what's interesting to see in the 20 years, that we had the downturn as well. So we actually lived through a cycle within that period as well.
Okay, good. And Lila, obviously, you weren't even born 25 years ago, so you're investing now here. What were the things that attracted you, and also the capital that you're representing, to specifically choose this area, the CEE?
Well, we started in 2007, and at the time, as Árpád was mentioning, things pre-crisis were quite hot. So Hungary, office development, let's say, that we currently concentrate on, was extremely expensive. Therefore, our initial target was residential, because it made more economic sense, let's say. 2-3 years ago, we shifted our strategy. We started looking at office projects. I must say that at the beginning, Hungary was a tough sell to our investors. We're talking mostly European or Middle East capital or US capital. The political situation was unknown, or let's say that it wasn't reassuring for that capital, so we had to do the pitch for the country. But the yield spread that existed between Hungary and the rest of the CEE, let's say, countries, made it an attractive risk-return opportunity. That has changed. What I mean is that it's much easier right now. Hungary has done an amazing job selling itself to investors. We've been reading about the country and about the potential for the last year and a half. So you guys have done an amazing job there. So right now, when you talk about Hungary, you don't have to convince that the country is worth investing in. People do believe that it's worth investing in. The political risk based on whatever else is happening in the world is no longer so important, let's say, or it's not so much considered a threat. And the yield gap that still exists does make the country attractive to the investors.
Okay, good. I mean, it's interesting actually that in some of the other sessions we've had, whereas when we were doing CEE briefings in London for UK-based global investors, often when we were looking at CEE, there would have been 2 years ago a straightforward rejection of Hungary. They would have just said, no, I'm sorry, the risk is too high. It doesn't pay me to go there. Why would I take that risk? Whereas that has definitely changed, which is quite interesting. And whether that's to do with the position here in Hungary, or whether that's just to do with the comparative position between Hungary and the rest of the world, is an interesting point. And Tibor, in terms of the developments that you're making, and when you're obviously selling assets and buying assets, what are you seeing in terms of the market? Is it more competitive? Are you seeing different types of capital coming into the market who maybe weren't here 2 years ago?
Well, definitely yes. During the crisis, basically the development potential was reduced to Warsaw solely. No, I think Budapest and Bucharest is definitely back on the map. Talking about the political risk of Hungary, I don't know whether the country changed or the perception of the country or the worldwide political environment, and it's because maybe the comparison Hungary is not so risky anymore. Today, if you switch on CNN, it's kind of like Game of Thrones. You see strange characters telling unexpected things, and this is valid from the Philippines through Britain to the US. So we are not so strange anymore with our political characters. But there is a well-founded economic growth in Hungary, with of course certain limitations. Based on some figures, we are now the eminent pupil in the school. Like the budget deficit is well below 3% and so on. But I have some question marks, some doubts whether this is sustainable. What will happen if the EU funds will disappear? What will happen if the interest rate environment is changing dramatically? Because this is at least some of the wealth of the Hungarian state is coming from these two sources. But anyway, I'm Hungarian, so I should be optimistic on Hungary, and I am. We are present in Warsaw, very active, and also on the secondary city residential market of Poland. I think Poland, I remember some years ago, in the beginning of the crisis, we arrived to Cannes, to Mappic, and on the cover page of one of the magazines, maybe it was PropertyEU, was saying that is Poland core? And I think Poland has a very good chance of stabilizing as core. I think it's considered core, but now they have, again, a political change that is bringing back to semi-core. But I think on a long run, Poland has great potential, and it will be a core country. I hope I can say the same about Hungary, and I think that there is a huge potential in Romania, with some limitation though, because if you look at the real estate cycle and you say that, let's say there is 7 good years, 7 bad years, and let's say that 7 good years are coming now, like in the Bible, then the problem with this window of good years is that if you go further to the east, this window is the narrower. So when good times are starting in London, it arrives to Bucharest 2-3 years later, and when bad things are ahead of us, then money disappears first from Bucharest. And as you go Bucharest, Budapest, Warsaw, it's the window is wider. So unfortunately, and I don't know whether Romania will work himself up to at least the Hungary level, because this good period might be only 2-3 years. But otherwise, there is a huge need for residential in Bucharest. There is a booming office market. Retail is doing tremendously well. Investment market is, maybe Lila knows more about it, but it's still a little bit limited.
Okay, good. Bence, maybe coming to you and drilling down a little bit into some of the sectors and some of the markets that you're seeing. Do you see the positive signs for retail? And how much are the sort of fundamentals that we've seen in terms of Hungary, where there's a demand, and obviously a great demand for more workers? Is that going to translate into a requirement for more office space, more logistics space? What's your sense of how those fundamentals are playing into the investment market?
That's a very good point. Fundamentals in Budapest, looking across the region, I have to confirm they're very, very solid. Look at occupancy rates, they are historic highs. In the Budapest office market, we have a vacancy below 10%. And this is 6-7 basis points stronger than the prevailing rate in Warsaw. I'm not talking about investment activity. I mean, I'll leave it a little bit later. But definitely the office sector is got a really strong going. The pipeline is still restricted, and there's a demand for office space. Probably by year end, we'll see vacancy rates narrowing down to 7% in Budapest. Logistics, manufacturing, that's also a very key part of the GDP contributor. Lots of manufacturing business signing up new business in Budapest. That's becoming also a very hot spot. As for Hungary, we see new retailers coming to Budapest. So overall, the fundamentals very strong. You pointed out that the pressure on wages, it's got an implication. It's got a contribution to inflation. To some degree even helps landlords and developers gaining some returns on rents. The issue is the very low unemployment rate that we see not only in Budapest but also in certain parts of the country, especially Western Hungary. For major BPOs and shared service centers, it's becoming a real pain to attract talent and pick up people from the market. Budapest's unemployment rate is even 4%. So I wonder how the big BPOs such as BlackRock, who's recently announced their opening of their offices in Budapest, how they get to entertain labor and fill up the vacancy they have at the moment.
And that's a good point. And I mean, we were talking earlier, Vlaho, about human capital, and you mentioned that in your introduction. How does Hungary compare? We also looked at what the opportunities were outside, maybe in terms of wages. But how does Hungary compare in your view of it from a human capital perspective? And is that going to be a block on some growth?
Well, I think it was pointed out in Mark's presentation that it's going to be an issue in manufacturing, and it is already an issue in manufacturing. How the shift is going to happen towards the other sectors, I think youth inclusion is important, training and access to vocational education is important, and that's something that we are trying to promote in countries where the gaps are much wider than in Hungary. But Hungary could benefit from programs like that, for sure. So I think that with the changes and shifts which are happening within the EU, with Brexit, obviously there is going to be some of the human capital coming back. But on the other hand, the actual core training needs to happen in the country itself, I believe. Yeah.
Okay, good. And Árpád, you mentioned before about the huge changes that there have been here. This area, developed largely by you guys, really, is a huge change on what there was. Is there still room for big development play here in Budapest? Are there still sites? I know that you're looking at a site just here. And is there enough demand particularly in the office sector to drive the new developments? How do you see those sorts of fundamentals playing into your strategic decisions about where and what you develop?
Yeah, as I've said, the market has changed significantly. And just to put it into perspective, if I say that TriGranit started out in '97 and within the 20 years basically completed over 1.5 million square meters of developments, 2.5 billion euros worth of value in 11 countries, then probably the same thing happened. We were just one of the players on the market and not even the largest player. The same happened to the entire region. This area was acquired basically by TriGranit in 2002. The area, what we mean is almost the total area between the two bridges. And here we have completed all the office developments, what you see outside, the Palace of Arts, where we're sitting here, and we'll continue. So close to 350,000 square meters just in this area. And as we have done here in Budapest, but also in Krakow, Poznan, and Katowice, or I could even mention Zagreb. We were more, let's say, a brownfield developer, in the sense of less greenfield developments. All these areas were ex-industrial areas, so we did regenerate them and attached it to the city or brought the city borders a bit further out. And obviously, when you look at the total stock, population didn't grow in this region. Consumption on an overall volume might have, but these countries and these cities are relatively well developed. I would debate the issue whether they're core or not, because I think the definition is something totally different for a core market. But if we look at the per capita development volume or stock in these countries compared to the GDP consumption levels, they're relatively well balanced out, which means that there is little or limited room for development compared to when the market was non-existent 20 years ago. So what happens? Retail is really probably more, the size of the population and overall consumption has a limiting factor. So I would see limited retail developments in Hungary, and I think this generally it's true for the entire region. Because you have the first generation, second generation, or third generation centers, you might redevelop some, you might extend them, but creating or doubling this market within the next 10 years is just not feasible and not possible, especially with online getting stronger, which will have an effect on the brick and mortar clearly. Offices is slightly different. If we compare the region with Germany and the GLA per capita, what's in the German cities, we're way behind that. Will we ever get to that level? That's the main question. Coming back to the workforce issue here in Budapest, official statistics, non-official statistics, but we think that 600,000 people out of the Hungarian workforce are basically working outside of Hungary. UK, Germany, France. 600,000, that would be close to probably 10%, 12%, 15% of the total workforce. What will happen to them after Brexit? Will they come back or will they stay where they are? Where can we draw in the manufacturing field labor? Only from Romania or Slovakia, but if they're going to be basically struggling with the same problems, there will be a shortage. Educated labor, which could be a block to the expansion of the SCCs or the BDOs. Again, it's a question. So I think there are a lot of factors, the size of the market, the sophistication of the market, and the available educated workforce does provide or set limitations to the overall development potential of Budapest in real estate or most of the countries in the region. Obviously, not the same way. And, as Tibor said, and that's where I disagree, that, it was only Warsaw for the last, 5 to 6 years. I mean, we've been quite successful in as I've listed, in secondary cities in Poland, that there is still room to grow. And Budapest will see for the next 2 years office developments happening. Funnily, last year, the new development of 96,000 square meters, new stock on the office side equals exactly the size in 97. So there's still room, but not to the extent, and I don't think we could see this going over the roof as we have seen in the past.
Yeah, go ahead, yeah.
If I could just pick up on Árpád's observation on brownfield developments where TriGranit made.
And I forgot to mention that Vlaho Kojakovic was our country director for Croatia, and the Arena Center was his development.
There's a link. There's a link.
Is that a celebration or blaming Árpád? What's the?
It's a fantastic developed, in my opinion, in Zagreb.
There you go. But the brownfield developments, which Árpád was referring, where TriGranit built a success, we can see that very peripheral places that EBRD is involved with, because we, by our definition, it's the brownfield resilient locations which are actually sailing through all sorts of issues. So we have a project today in Amman, which is next to Syria with all the problems, but because it's downtown Amman, it's a brownfield development of 60,000 square meter retail, it's 100% full. It's actually one of the more attractive investments that we did over the last 5 years. The same with Cairo, where shopping centers go to 150, 160,000 GLA. Because of the sheer population and the lack of parks, people actually spend time in shopping centers. Security is there, all is there. So again, it works. We did another one in Lviv in Ukraine with all the problems in Ukraine. That shopping center today is 100% for us. It was that. They are prepaying. Multi-developed it, Blackstone bought it. So you can see that even these peripheral places, if it's the right product at the right location, it's attractive investment opportunity even for American funds.
Okay, good. And Tibor, you wanted to come in on that because you're developing, obviously, Etele Plaza.
Yeah.
Obviously, a big retail development. What's your sense of that? What was driving that decision for you?
So since we are just launching a new big shopping center development, my duty is to be more optimistic on retail than expressed by Árpád. But I tell you some figures. 2 years ago, we had a study made by GfK Market Research, and they for the CEE region, and we also included Austria. And there was a very interesting figure in this study. If the European average free spending power was 100, I'm talking about free spending, which means that all your regular monthly cost, whatever is left is your free spending power, then Austria was 168, and Hungary was 38. And I think that as the wages are growing, as we saw on Mark's table in the CEE, the free spending power is actually growing on a much faster pace. So now the minimum wage is in Hungary was just increased by 15% by the government. People living on the minimum wage has probably a free spending power of maybe 30% of the total salary. So this could mean that actually the free spending power of these people is increasing now by 50%, which is, I think it's a great news for retail, for shopping centers and for all formats of retail. I know that there are drawbacks. I know the e-commerce problem. You probably have heard about the strange innovation of Hungarian government, which is called the Plaza Stop, which is a ban on retail developments. But still, the figures show that last year, I think the consumer spending was up by 4.2%, and non-score spending was up by like 7%. And some fashion retailers reported 10 and 12% increases. And actually, H&M reported the highest growth of spending in Europe was in Hungary. So I think that there is potential in retail, maybe in the quality of retail.
Okay, good. And Bence, in terms of the e-commerce was mentioned both by Mark but also on the panel. What's your sense of that, how that's developing? Obviously, logistics, very big in Poland, Czech. Do you think that sort of drive for logistics is going to also move down Vienna, Budapest? How do you see the logistics and the retail side and the e-commerce side?
Yeah, e-commerce was a fairly slow business last couple of years in Hungary. I think the market share of e-commerce was about 3 to 4% of overall spending. But the growth rate's been quite remarkable recently. Hungary, unfortunately, is a fairly small market compared to Poland. So when Amazon was pitching where to put their CEE or European location, there's no question they would go to Poland. But they also opened in Czech Republic, and there's a competitor to Amazon who's currently screening Budapest for the major European foothold. Hungary is fairly well placed to get close to that operator. And existing players, they also heavily increasing their occupation. It's definitely a driver for the logistics sector. It's mostly Budapest or around Budapest, not countryside. Countryside is more manufacturing, I would say. But there is a tremendous growth in that sector. As Mark presented, e-commerce is picking up 30%, 12% on an annual basis in Hungary. And that's against the 7-8% retail spending growth across Hungary. So e-commerce is gaining market share, occupiers growing, and the ongoing live requirements, even from existing operators for relocation, who can't really fit in their existing space.
And if you get somebody like Alibaba wanting to choose Budapest as its European hub, I mean, that's going to make a huge difference, isn't it? I mean, in terms of the market here, if they do choose Budapest.
Oh, absolutely. I think Hungary is really well placed. We've got a fantastic infrastructure, proximity to major European markets. The motorway network is just excellent. I mean, it can't be compared to Poland. Significantly wider network. But as pointed out earlier, the risk might be the access to workforce and labour. And if there is an operator such as Alibaba placing 80,000 square meters, they would probably need to employ about 8,000 to 10,000 people. And that could be a little bit of a headache to these operators, as the access to labour is just fairly restricted.
Okay, good. I wanted to just look a little bit at what the investors are thinking and the capital that's beginning to look. And Lila, you've obviously got money from across the world coming into your funds who are interested specifically in the type of opportunities that are here. Can you just tell us a little bit about the makeup of some of those investors, whether they're from the US, Israeli money, where's that money coming from? And have you seen that change? Have you seen a shift in terms of new investors wanting to access these markets?
The short answer is yes, we have seen shift. The long answer is we've started our initial investors in our platform back in 2007 were mostly Middle East, sovereign wealth funds, US capital. With the commotion, let's say, that exists in the world today, what we see is that capital tends to invest locally, and by locally I put a big, if you want, span of what's local. So, for example, if I use Hungary, I'll say, and Mark showed it, that a lot of the investments that happened and continue to happen in Hungary that has driven the yields down is local capital. Just because the local capital feels that, the political risk that existed 2 years ago, or that people perceived that existed 2 years ago, wasn't as important or wasn't as critical as outsiders would think. This is what we're also experiencing in terms of the capital raised right now for properties in Europe. So we see a shift from the US and the Middle East more into European money, West European, let's say, money, looking as diversification into the Central and Southeast Europe. So US capital is feeling comfortable with the US market. We have some shift. We see US capital diversifying, since the motto of this crisis is diversification. So we do see US capital coming here to diversify, but the majority of it still remains in the US. UK capital has not totally left the country, I think, even after the Brexit vote. We still see some capital coming this way, but a lot of times it's, UK mentioned capital, which is though locally located through AIM or through vehicles like that, but on the backside they do have the local knowledge and the local players raising money through AIM. And so what I see in the CEE and SE region is a lot more European capital coming this way, which they feel comfortable with all the changes that are happening in Europe, or with all the risks that supposedly we will face in 2017, and they are not as afraid as the Asian or Middle East capital who just read, news on CNN, CNBC, and get scared.
Okay, good. There's a huge kind of view of, of people looking at what's in the headlines and just deciding, okay, well, I'm not going to go there because there is this problem happening. One of the things that you mentioned, Árpád, that you'd had success, particularly in Poland, with secondary cities. How much more room is there, do you think, to develop into those secondary cities? And is that an opportunity also for Hungary as well as Poland, or are the secondary cities just simply too small here for proper investment? What's your sense of it?
Yeah, that's a good question. I mean, obviously we have had success wherever we have developed, not just the secondary cities of Poland, but we were an early player entering these markets as early as 2003 and rolling out projects basically in the past 12, 13 years continuously. I think the Polish secondary cities still have room for growth on the office market, especially because of the SECs and the BDOs. Krakow, which is like a university city. I mean, population, core population, somewhere around 600,000 people. If you look at the overall catchment, goes above 1 million, 1.5 million, and stock currently, Class A office stock is somewhere around 600,000. So there is still room to grow. And we have completed over 80,000 square meters of office developments, and we're fully let, and we're continuing there. And I think it's true for Wrocław as well. I mean, the issue about the secondary cities, we call them secondary cities, but frankly, if you look at the size of Warsaw, which official statistics, I think it's like 2 million, 2.1 million. People claim that with the catchment overall, it's like 2.5, maybe 3 million people. But you have cities, 7 or 8 cities, where the population is close to 1 million with the overall catchment on their own, and due to the distance from Warsaw. I mean, Poland is unlike Hungary, where basically everything is in Budapest, and this is a good thing, and it's just as a bad thing. Poland is a lot more balanced out, so you can't really compare to that. I think Romania is probably a better comparison to that with the secondary cities, because in Romania you have 5 or 6 cities where the population is above 300,000 or around 350,000 people. The second largest Hungarian city, it's always a debate whether it's Miskolc or Debrecen. I think it's Debrecen, it's somewhere around 200,000 people, and that's it. And Budapest, still around 1.7, 1.8 million. So, unfortunately, I don't see the secondary cities in Budapest in Hungary, gaining momentum simply because there's no potential for growth. And they're not big enough to sustain these markets. And the other thing, they're not far enough from Budapest. I mean, you know, Debrecen is a 2-hour drive on the highway, but Vienna is a 2-hour drive. Or Bratislava is a 2-hour drive from Budapest, so it's a bit difficult. So I'm not too positive about that.
About those, there's little.
You should ask maybe Tibor. Maybe they're developing something in the countryside.
Tibor, anything you need to mention?
If you asked me even a year and a half ago whether I would develop something on the countryside, I would have said no. But actually, we are now building an office building in Szeged, which is, I think, 150,000 people, and it's becoming like an IT shared service center within Hungary. And the reason why we do this office development is because we were asked by one of our major tenants from Budapest, who has problems of hiring people here in Hungary, but Szeged has a big university which has a huge IT faculty. So based on that, they signed a 12-year lease, and we are completing now a relatively small 7,000 square meter office building in Szeged. But I agree with Árpád that this is a one-off case maybe, and it's a difficult. And if you ask me about exit, I'm sure that there will be demand for a 12-year lease of a major IT tenant, but on what yield, I cannot predict.
Yeah.
Do you have transactional evidence on secondary cities?
You may want to have the
Secondary cities in Budapest on yields, offices, or retail?
Secondary cities, yields, offices in Hungary?
Yeah.
Well, the market transactions, no. But you may recall there was a bigger transaction, a portfolio deal by the National Bank's foundation, which included an office building in Debrecen. So there's an allocated price. Potentially, we could work out the yield on that deal, but it's probably not market relevant. Haven't really seen any office deals, to be honest, in the last 5 or 6 years in the countryside. It's the same problem as Tibor mentioned. Budapest is sort of a safe haven for investors. They see the exit. domestic funds. They set a very strong footing, transacting 500-600 million on an annual basis. That's enough liquidity for international capital to come in. And it's perceived as an easy exit should times change. But secondary cities, no. It's obviously retail and logistics and manufacturing, that's different. But offices, unfortunately it's a hard no.
You want to pick that up?
Yeah, just from the EBRD perspective, we have extremely strong lessons learned from the secondary cities in Romania, in Russia, Croatia, not Poland that much, where the truth is somewhere in the middle. We went with big developers who build oversized projects for the secondary cities, and these are the projects that are in continuous restructuring. So I think, linking the smaller places, probably you go for domestic developers or small developers that are not necessarily looking for exit on the investment markets, but for yielding properties.
And that kind of matches in a way, Lila, because you're obviously investing actively in office, but you're really sticking to the main capitals almost in terms of your strategy. Do you get offered other opportunities, but you simply don't think that there's an exit for you?
Yes and yes. So we do get opportunities in other cities, both in Romania, Czech Republic, I would say, not so much. Hungary, I think I've seen just once, maybe a project, and Bulgaria. No, not Futureal. And okay. But the problem is what Árpád mentioned. It's illiquid, and Tibor mentioned. It's illiquid markets. Hotel California, you go in, but you cannot go out. You can never leave. So and also it's the cities that will suffer the most should a turn happen. And because we do believe that the existing euphoria is not something that will be for the long run. I don't know when you started, Tibor, counting the 7 years, so which part of the cycle we are or you think we are. But I do believe that we are towards the peak right now. We are extremely cautious as to the projects we select for our investors. We try to see the long-term sustainability and the fact that they can survive a next cycle, a next downturn, and look at the exit in 5, 6, 7 years from today.
And are you looking at, when you're talking about long-term sustainability, you're talking about that across the board? Are you talking about sustainability in terms of green or sustainability in terms of the asset overall? How do you see that?
Both. We are looking, since we do try our investments to be with international tenants, what we have seen is that the sustainability in terms of green buildings is extremely important to the international tenants, mainly US, which are the main occupiers of the BPOs and shared service centers. So I think we start with that. And also in the process, during our asset management, we always try to improve it as much as possible and take steps to make the building more efficient in terms of energy consumption and green. At the same time, I'm also talking about asset sustainability. So not only that the building should be well built and should be good quality, which will last for 7-10 years with capex, of course, but not, rebuild it, let's say. But at the same time, sustainable tenants, longer, let's say, leases. So our investors are more core plus, I would say. So it's the long-term, with a long-term view. So these are also the type of investments we're looking.
Okay, good. One of the things that Vlaho, I wanted to pick up with you is you mentioned that you were both investing but also lending into the market. What's your feeling about the lending environment? Because interestingly, we were in Stockholm last week where financing was actually beginning to get a little bit more difficult there, but it seems to me that actually the reverse is true here.
No, absolutely, and actually this is where we are, I wouldn't say struggling, but we are very pleased, and what Mark was mentioning, there is, the markets are washed with liquidity to the point that today, for example, we were doing a deal in tourism in Croatia last month. You have the pricing that went below 2%. That never happened in 2007. And you do have that because Intesa, with 6 of their banks, can blend their funds, and they have so much liquidity in the system that they are ready to lend, although the country risk in Croatia is higher than 2%. So, on the other hand, this liquidity is good because it's going to prevent another crisis. So I think that it's important that it's there. The question is whether it creates a bubble. So that's a balance that these guys have to be responsible for what they are building and how much they build and so on.
But I think what we are forgetting in financing is we benchmark ourselves as how good or what the financing is based only on the margin, or all-in rate, or whatever you want to call it. What makes us, or makes me less worried this cycle versus the 2007, and I don't know, it depends as to how long this euphoria will last and whether we'll forget the lessons we learned, is that amortization rates are not as extreme as they used to be. And banks are financing, good LTVs, but then again, that depends on the project. So they are not as bullish, let's say, as they used to be, or at least as we've seen them back in 2007, 2008. The rates are very low, and actually that's across, I think, CEE, and we started seeing that in Southeast Europe as well. But that's because of the environment. I mean, it's cheap money out there from all sources, so why not? But the rest is still very conservative, I think.
Okay, good. Árpád, yeah.
Can I just add something to this? I mean, again, you have a contra-cyclical movement within the region in that respect. Today, we can get better financing terms in Budapest than in Poland for developments, which we never thought would be the case. And not because the Polish rates have worsened to that extent. They have, I mean, there was a correction with the new bank tax being implemented, but because the Hungarian rates have, or lending parameters have improved so significantly within the last 12 months, it's just amazing. But that means that there's a lot of liquidity out there. The banks are forced to be lending, and obviously, any good project, they would. I don't know about the others. I mean, we are only looking for financing for our own projects. So, this is working for us. But it's interesting to see what have happened. And whether there's a bubble or not a bubble, and where the cycle is, I think this is the other key thing when it comes to investments or developments, as Vlaho and Lila picked up on it, because if you're looking for an exit in 4 or 5 years' time, then you have a problem. If your cost of capital is high, you can't really underwrite, because, yeah, there might not be the same crisis as we went through in 2008, but there will be some kind of a correction, which will have an effect on liquidity, will have an effect on all sorts of factors, especially if, the interest rates bounce back. Obviously, yields will have to maintain the difference, the spread between the interest rates, so they will go back as well. So I think the important thing is when you look at investment volume and who is buying now, it is truly core capital. Because they are the ones, either the closed-end funds, when they say, okay, I'm going to invest and I have to invest, I'm going to hold it for 5 years or 10 years, and it makes no difference for me what I'm doing, and I have cheap capital, so my returns can be lower. Opportunistic capital in this region is not really finding opportunities, because having to underwrite exit in 4 years' time when you don't know where the market's going to be. We're saying, yeah, yields will compress probably for the next 2 years. Where will they be 4 years from now or 5 years from now? If they're on the same level as they are today, then it's pointless to buy unless you're a core investor, because there is no yield compression, no added value. So it's very interesting. And I think what Vlaho picked up quite rightly, and it is true mainly for Southern Eastern Europe, that if you have a developer who's looking for cash returns or income and not looking at exit, then yes, there is opportunity. We're struggling from the same thing as basically Zeus or some of the other investors, that when we do a development or we look at an acquisition, we have to look 4 years ahead. And we have to be able to underwrite returns 4 years from now. And when we all say that 2008 plus, 9 years? It's 2017. And the cycle was between 7 to 9 years on average. So where are we in the cycle? Really getting close to the peak. Should I be buying at the peak, or should I be waiting until there's going to be blood on the streets again 2 years from now or 3 years from now? But there's definitely room for developments, because your development yields will always compensate you with even wherever the yields are, even if the yields are bouncing back. Sorry.
Okay, no, good. Bence, you wanted to pick up some of that point, but also the financing point, I think.
Yeah, two things. As Árpád said, yes, the financing landscape has significantly improved in the last couple of months even. But it's still fairly expensive compared to other major, let's say the major core CEE markets. On standing investments, definitely more expensive than in Warsaw, and significantly more expensive than in Prague. So there's definitely a long way to go on the financing side. LTVs, yes, we may get to 70%, but still significantly below than other markets. And what Lila pointed out, the amortization period, that's also increasing, but it's still very far from what we saw in 2008 and 2007. On standing assets, still margins above 200 bips. It's very expensive, I would say, but it's improving for sure. The other thing that Árpád mentioned, the buyers and the quality of buyers, investors, and the perception. Yes, there was a dramatic change in the last 3 to 4 years. The pool of investors very different to the one we had in 2007, 2008. At the time, foreign capital was predominantly quick traders buying in and just taking benefit of rapid yield compression, potentially rental increase. But now 60–70% of the market is investing over a longer holding period than 7 to 8 years. So they're going a little bit anti-cyclical, and as said, 40% of the market is domestic capital, and then we have the German core closed-end funds who are underwriting transactions on 12 to 15 years. If you bought an office building in 2007 at let's say a really good one, quality one, core asset at 575, then you'd be losing out money today. But probably not as much as is in some other countries, not only in the region, but also in Western Europe.
Okay, good. Tibor, I just wanted to come to you because you mentioned that you'd been active, surprisingly active in a way, but in the residential side, mainly residential to sell rather than as an investment class. We did a session in London 2 weeks ago, which was on student housing, micro-living. Is that an opportunity that may be coming here? You mentioned that you'd just done development in a university town for office. Is there potential for these kinds of build-to-let sort of PRS-type developments here in Hungary or across the region in terms of student housing or micro-living or those kinds of things, or is that not likely to be an opportunity in these markets?
Well, it's not happening on an institutional investor level, but it's happening on a private investor level in large scale, actually. We have a flagship project. It's called Corvin Promenade, actually not very far from here, where we built altogether almost 3,000 apartments. And I only bet that at least half of it is bought by private investors for reletting. And it's because the universities are very close. It's very easy to do this. And we have seen lots of cash money coming out of banks and going into residential investment, since you are earning nothing in your money in banks. So we've been on the market. Cordia has been on the residential market for almost 15 years now, and it's been the leasing residential developer since 2006. But last year was the best year of its history in terms of sold apartments.
So increased growth in that, but mainly at the moment, it's not necessarily for people to buy to live in, but it's for smaller investors who are then buying and letting that out to the market.
Exactly, it's for long-term letting, mostly for young people and university students, and for Airbnb, of course, which is a big thing in the last 2 years.
Okay, good. I just wanted to check if there are, I've been very remiss and have not asked about questions. Are there any questions that anybody has got that they would like to ask the panel?
I just wanted to ask you to comment on the hospitality market and how do you see it in Hungary in general? Any trends, consumption, spending, investors?
Great, thank you. Hospitality market.
Yeah, maybe I can just pick it up both regionally and Hungary-wise. It's very interesting what we are seeing, because we invested a lot in hospitality throughout Southeast Europe, but also in North Africa. We can see that North Africa, Jordan, Tunisia, Egypt are not coming back soon. And actually there's a structural shift towards city as well as resorts which are in Southeast Europe. Not only coming now from the development point of view, because ADRs are increasing, the supply is relatively stable, but the demand is there. And the fact that security started playing such a role, Budapest and Hungary are becoming extremely interesting for the European tourism, and we could see that in the number of inbound travelers which are coming into this country, but also South Croatia towards Greece. Second thing, we are doing quite a lot of work with United Nations World Tourism Organizations, which is tracking inbound tourism from around the world. Chinese travelers are today the largest proportion of new inbound travels into Europe. And for them, packaging Hungary, and I think Hungary has a very good relationship with China in terms of visa regimes and all the rest, is extremely interesting potential both for Budapest as well as secondary cities.
Zoltán Simon from Bloomberg. 2 questions. One, there's a lot of talk about shared service centers and about their importance. Can you give us some size and scope in terms of how important shared service centers are for, let's say, the office development market? I mean, is that the sort of the main sort of engine or the main demand for that, and how sustainable is it, both in Hungary and, by the way, in the region? And the other thing is there seems to be a hotel boom going on, certainly in Budapest, probably elsewhere as well. And I was wondering, what investment opportunities there are. Is there a lot of demand from investors actually to invest in that?
So I don't know the exact figures or proportion of shared service centers. I mean, Colliers probably could give you a more precise number. But if you look outside here and the 160,000 square meters office space, which is next door, I would say 70% is occupied by shared service centers. In Krakow, we see that 90% of our tenants are shared service centers. But I think, I don't know what is the exact figure there. But they're truly very significant.
Yeah, in Budapest, we're talking about an office stock of 3.3 million square meters at the moment. Roughly about 1.2, 1.3 million is BPO or shared service centers, classical ones. I think what's more important is if you look at the previous year's total demand for office space, a very large share of those demands was coming from newly established BPOs and shared service centers. So I think their importance is drastically increasing. They used to be a very important sector for landlords and developers, but their importance is ever growing. As Árpád said, I mean, if you look outside, you have Morgan Stanley here taking, I don't know, maybe 20,000 square meters, and you have Vodafone on similar size. So it's a very big business and becoming more and more important. As for hospitality and investment opportunities, the 5- and 4-star hotel segment is currently the most sought after by international capital. Although it's very difficult to have access to those type of assets and properties, so the number of opportunities is very scarce. It's extremely difficult. And the 3-star segment, it's mostly development, but we see currently ongoing refurbishments, major renovation projects. Those are the ones that investors/developers are currently chasing after.
I've got a sort of last question that I sort of ask quite quietly, and but it's really designed for you to tell us how people should invest, where you think the investment should go. And personally, as you can tell by looking at my suit, I really don't have enough money to live properly, and I'm beginning to fear dreadfully about my pension already. So if I were to give you some money, where would you invest it so that I can live in a life of luxury in my old age? I can obviously buy a house from you anyway, Tibor, so that's fine. So that's dealt with.
You have Colliers next to you. You should ask them.
And I should ask how much money you have.
Okay, how much money do you? I'll give you 500 million, and you need to invest it over a 5-year period. And I'm happy to take whatever risk you're prepared to give me. And we'll start with you, Bence, since you asked. 500 million. How will you spend it? Yeah. Invest it. Sorry, not spend it. That's a different matter. It's for me to spend later. How will you invest it on my behalf?
500. That might be a little bit exaggerated amount for Budapest and Hungary. What we've seen last 5 years, I mean, if obviously your point of investing is pensions long term, since market exists, office seem to be pretty much the let's say the safest asset class to invest in. So I would at least put half of your funds into offices. Logistics, industrial, they've done tremendously well in previous years. So I would also allocate roughly about 25%, and that's predominantly logistics around Budapest, and the rest definitely retail high street. That's very sustainable investment style as well.
Okay, good. Tibor, where should we invest?
Well, of course, in Futureal buildings, but if you have 500 million and you even want to leverage it and you say you have $1 billion, then I should say you are in trouble in investing this. And you see people with big amounts of money running around in the CEE having trouble spending it. Where should you spend it? I really truly believe in the Budapest office market. I think yields are still like at least 50, but maybe 100 basis points higher than in Warsaw and Prague. It's a stronger capital city than even Warsaw. I mean, as far as the importance within the country. I should say that you should invest in retail in Central and Eastern Europe, and I described the reasons why, except there are hardly anything for sale. So it's a difficult question, but this amount of money, just to tell you the size, we saw Mark's presentation that last year Hungary was 1.7 billion investment market. last year in the Hungarian property funds, 550 million was pouring in, and it keeps coming in. So there is even competition for your 500 million. So no clever advice really.
Lila, you don't need to put it all in Budapest. You can put it elsewhere.
Well, I would definitely wait and not put all in one country. Bence and Tibor said it. It's too much money even for the region if we take it unleveraged. So, okay, I would say office because that's what we believe in and that's what we've been doing. But I wouldn't necessarily spend it all at once. So. Careful consideration, looking at the fundamentals of the sustainability of the office, as we said, which you can spread it across the CEE and SEE region. But then I would keep a good chunk of that money and look at Western Europe, based on what we've been hearing and the disruption, whatever you want to call it, that may be coming this way. So maybe UK could be a good opportunity in a couple of years' time, or other cities in the West.
Okay, good. Whereabouts? Where would you say? Where should we put our money?
I think within the limitations of this region, I fully agree. I think that office platforms are missing. We can see retail being picked up by South Africans. As Tibor said, very little is left in terms of prime yielding assets. That's gone. But actually, office is still there and it has a potential. I would go back to Bloomberg question. I would look at hospitality as well, because there are vertically integrated players such as TUI and Thomas Cook's and others who started putting equity actually into assets, which they stopped doing 10, 15 years ago. There are big American funds that came back and are looking to invest into hospitality in this country as well as Southeast Europe. So these two subsectors would probably be something I would look at.
Okay, good. And Árpád, where should we invest our money?
I had to step out to call our analyst so we can
okay.
Give you the right answer. And
you weren't checking my bank account.
And I immediately got questions from them. How much, for how long, and what is the return you're looking for?
Okay, well, let's because we've decided 500 million, and I think
it's equity, yeah? 500 million equity.
Yeah, I said 5 years, and I don't mind leveraging. So I mean, we could do that.
Return.
Return. I'm hoping to, in Mark's sense, what I'm hoping to do is beat bond yields. So I'm hoping that real estate is going to give me a better return than bond yields.
Okay, then it's relatively easy.
That's what we like.
Yeah. Offices, shopping centers in the region, because you will get better returns and yields on those, whatever happens. I mean, as long as they're fully let.
Okay, good. Very last question, which is because this is this is the last of our outlooks for 2017. But starting with you, Árpád, what is your personal and your business, give me one of each, aspiration for 2017? We had one, by the way, in Stockholm who said they were going to do an Ironman competition, which was not a personal aspiration of mine because it would almost certainly kill me. But what are yours, Árpád?
No. I could quit smoking, I could say that. I mean, that could be a good personal target. I would say in business, basically, so we can launch and start over 70,000 square meters of office developments in 3 cities, Budapest, Bratislava, and Krakow. Maybe even in Katowice, so we could go up to 100,000 square meters of office developments this year. And obviously acquiring 1 or 2 larger assets in the region, retail or office, but probably I would go for retail platforms or regional large centers. I mean, if we could manage that this year, then I'd be extremely happy.
Okay, great.
So it's a very EBRD-ish answer, but we were trying to break into two markets which we find difficult, but investments very important. One is Greece, and I was talking to Lila. I will be going there for a couple of months to try to see how can we develop business there.
That's just a holiday, isn't it? We call that a holiday if you're going in the summer.
It's April as well.
It's coming in the summer.
Yeah. And the other one that we are trying to do actually for the last year and a half is try to work in the West Bank in Israel. And we see there is a potential, there is a need there, and we'll see if we can achieve this year. Yeah.
Okay, good. Lila, personal aspiration, business aspiration?
Well, help Vlaho find investments in Greece. So we can spend more time there, especially during summer, so that would be great. I think for business, getting more serious now, it's continuing the investment program that was started for us in 2016, which has been very good and has started strong from mid-2016 onwards. So continue that, expanding countries, expanding projects, and choosing wisely, let's say.
Okay, good. Tibor.
Well, my one is very personal. Since we are launching the development of Etele Plaza this year, and since we are living in a 10-minute radius from this future shopping center, my wife has a long list of wishes what she would like to see in this shopping center. So no, I'm very pressed. I'm very, very much pressed to make this the most successful and nicest 21st century shopping center in Budapest.
Excellent. For personal and business reasons. Very good. Bence.
Definitely improving all my tennis skills. As for business, we had a very solid 2016 as Colliers on various fronts, but also on investment. We transacted nearly 180 million euros of office buildings and other investment assets. So getting close to that number in 2017, that would be already fantastic. But we hoping that we could get beyond that number in 2017.
Okay, good. Well, and I look forward to meeting you all in about 2 minutes in that room there. But in the meantime, if you could join me in thanking both yourselves and also the speakers, I would be grateful. Thank you.